Welcome to Maple Leaf Money, a Canadian-born movement for financial clarity. We simplify money, cut through the noise, and help you make informed choices that build confidence and long-term stability. Let's grow your financial literacy, one episode at a time. Today, we're talking about investing, what it is, why it matters, and why it is not only for wealthy people. In the last episode, we talked about inflation and how money can quietly lose purchasing power over time. Even when someone is saving responsibly, inflation can slowly reduce what that money is able to buy if it sits still for too long. That is where investing enters the picture. Now, for many people, the word investing can feel intimidating. It can sound technical, risky, or like something meant for people with large incomes, large portfolios, or a lot of financial knowledge. But that idea needs to be challenged. Investing is not only for the wealthy. It is not only for experts. And it is not only for people who feel they are already ahead financially. Investing is for ordinary people too. Some people begin with more money. Others begin with less. Some start early in life. Others start much later. Some can invest larger amounts. Others can only begin with small or modest amounts. Everyone has a different starting point. What matters most is not where you begin compared with someone else. What matters is that you begin in a way that fits your own financial situation. Real progress often starts small. At its core, investing means putting money into something with the goal of growing its value over time or earning income from it. Instead of leaving all of your money sitting still in cash, investing allows some of it to go to work for you. That does not mean every investment grows smoothly, and it definitely does not mean investing is risk-free. But it does mean that investing is one of the main ways people try to build wealth, earn returns, and strengthen their financial future over time. It is also important to understand that not everyone is in the same position financially. Not everyone has the same income, not everyone has the same bills, debt load, family responsibilities, or financial pressures. Some people have room to invest sooner. Others need to build more stability first. That is normal. There is no perfect starting line that everyone must cross before investing becomes for them. The best place to start is wherever you are, with whatever room your finances realistically allow. For one person, that might mean building an emergency fund first. For another, it might mean starting with small monthly contributions. For someone else, it may mean beginning with a more cautious investment product before taking on more risk later. Progress does not need to look the same for everyone. One of the biggest mistakes people make is assuming that small amounts do not matter. They do. Modest amounts saved and invested consistently over time can grow into surprisingly meaningful sums, especially when they are given time and handled wisely. That does not mean every small investment turns into a fortune overnight. It means that consistency matters and time matters. Small steps repeated over and over often lead to bigger results than people expect. You do not need to begin with huge amounts of money. You need to begin with a sound approach and the discipline to stay with it. Now, saving and investing are both important, but they are not the same thing. Saving is usually for money that needs to stay safe, stable, and easy to access. It is useful for emergencies, short-term goals, bills, repairs, travel, and purchases coming up in the near future. Investing is generally for money that can be left alone longer, so it has a chance to grow or earn income over time. Saving focuses more on safety and access. Investing focuses more on growth and future potential. That does not mean one is better than the other. It means they serve different purposes. A healthy financial life usually needs both. So, why do people invest? People invest for different reasons. Some invest to build wealth over time. Some invest to earn income. Some invest to help stay ahead of inflation and protect their money from losing purchasing power. Others invest so they can work toward major long-term goals like retirement, home ownership, financial independence, helping children, or creating more freedom in the future. Investing is not only about trying to get rich. At a more basic level, it is about giving your money a chance to do more than simply sit still. It is about trying to make your money more productive over time. It is also worth saying that not all investing begins with stocks or the stock market. Some people begin with simpler products like guaranteed investment certificates, often called GICs or term deposits. In the United States, a similar product is called a certificate of deposit, or CD. These products can earn interest over a set period of time and are often easier for beginners to understand. They may also feel more comfortable for people who want something more stable and predictable. Now, these products usually offer lower growth potential than riskier investments, but they can still play a useful role. They can help people begin learning how money can earn a return rather than simply sitting idle. For some people, this can be a reasonable early step. It is important to understand, though, that simpler and safer products often come with a trade-off. They may provide lower returns, which means they may not keep up as strongly with long-term inflation or long-term growth goals. Still, they can be part of a balanced starting point. Beyond GICs and term deposits, people can invest in many other kinds of assets. These may include stocks, bonds, mutual funds, exchange-traded funds, real estate, or even private business ownership. Each of these works differently. Each comes with different levels of risk, income potential, growth potential, and complexity. At this stage, the important point is simply this: investing is not one single thing. There are many ways to invest, and some are more conservative, while others are more aggressive. Now, this next distinction really matters. Not every activity involving money and risk is true investing. Real investing is not the same as gambling. Real investing usually means putting money into something productive with the goal of building value, earning income, or growing wealth over time. It is generally tied to patience, discipline, and a long-term mindset. Gambling and speculation are different. They are often driven more by short-term bets, guesswork, excitement, hype, or the hope of a quick payoff. In those situations, the focus is usually less on steady long-term progress and more on trying to predict short-term outcomes. That is not the approach we are promoting here. At Maple Leaf Money, investing is not about chasing thrills, hype, or fast money. It is about using patience, consistency, and sound judgment to build financial strength over time. It means understanding what you are putting your money into and why. Real investing is usually quieter, slower, and less exciting than gambling or speculating. That may sound boring, but boring is often a strength when it comes to building wealth. Now, it is also important to be honest about this. Investing is not risk-free. Some investments can go down in value. Some are more volatile than others. Some may perform well for a time and then struggle. Others may disappoint for long periods before recovering. This is part of the trade-off. Unlike savings accounts and other very stable products, investments usually involve uncertainty. In exchange for the possibility of higher growth or income, investors accept that values may move up and down. That does not mean risk should be feared blindly. It means risk should be understood and managed carefully. One of the biggest advantages in investing is time. The longer money has to grow, the more opportunity it has to build on itself. This is one reason why steady habits often matter more than dramatic moves. A person who invests modest amounts consistently over many years may end up in a stronger position than someone who waits for the perfect time or keeps starting and stopping. Consistency matters. Patience matters. Time matters. Investing usually works best as a long-term process, not a short-term race. And that leads to a healthy beginner mindset. Beginners do not need to know everything right away. They do not need to rush. They do not need to compare themselves with people who are farther ahead. And they do not need to chase whatever seems exciting in the moment. A better approach is to start with a calm and practical mindset. Build some financial stability first. Keep an emergency fund. Learn the basics. Start with an amount that fits your life. Focus on long-term progress rather than short-term drama. The goal is not perfection. The goal is progress. Investing is not about hype or quick wins. It is about giving your money a chance to grow over time and helping protect it from losing purchasing power. For many people, it becomes an important part of building long-term financial strength. You've been listening to Maple Leaf Money, a Canadian movement for financial clarity. Every choice, every dollar, and every lesson builds toward a stronger future. For you, your family, and our country. Subscribe, share, and help grow financial confidence from coast to coast to coast. Until next time, remember to continue to learn, earn, and grow.